Hello, I'm Mi Jun from the University of California. We will begin the Mi Jun weekend broadcast for May 31st. My regular weekend broadcast is a special broadcast, but from now on, it will just be a regular weekend broadcast. When I do the broadcast every week, it doesn't seem right to call it a special broadcast anymore. Now, let me reintroduce Kim In Jung, the representative of the Beautiful Palettes composition team. Welcome back. Hello, Mr. Kim. Yes, hello, Mr. Kim.
That's right now.
It's like family. Even though Mr. Baon Knoll, the representative of our YouTube channel, was always on the podium, it felt like the season was over. But now it feels like we've become a crazy channel where I get to run the show together with the representative. So I'm very happy. You didn't become a regular cast member, but do you think there's been any change in your relationship with the show since then? If there have been changes, briefly introduce them.
Recently, I explained how to view the portfolio screen as a one-stop guide, and many people showed interest. In fact, a lot of people have signed up and are actively using it now. Among the portfolios recommended in the past, there were some that were not filtered out. So we said we would add that feature, and today the update is complete. I will explain the screen quickly, and if you try it out, I think it will be very helpful. So on this screen, you can now see the groups you were interested in and the groups you created yourself all in one place. At that time, I focused on setting up my own portfolio, as I mentioned earlier. So when you look at the midterm portfolio, you can see Tesla, Amazon, AMD, and so on, along with me. And at the top where it says original selection, if you click there, you can see the current portfolio as it is right now. NVIDIA, Meta, AMD, TTD, and Amazon are the key stocks. This section focuses on defining your investment philosophy and objectives, which you can develop while considering your long-term investment strategy. So if you look at this table, it shows that your style is focused on growth stocks and mainly on buying.
That's right, originally.
If you try dividend stocks now, you'll see how it goes. But until recently, it was different. If you go into the menu now, you'll see that last week for portfolios like Portfolio Rio, you were told to focus on the mid to large caps in the market and to avoid the small caps for now. But now the recommendation has changed to include more small and mid cap stocks. So if you keep holding on to those portfolios, do you think you'll be okay? So what I'm suggesting is that this is a kind of service, but if you look here, it's a list of stocks that are currently on sale. And even now, if you look at the composition, it's still a context of this kind. Back then, there was no sorting function, and you could only scroll down, requiring a lot of scrolling to find the right companies. That's why I explained the companies in detail, one by one, so you could search for them yourself.
Here, the option is.
With the filter function, you can examine currently trending industries in the market. For instance, you can filter for growing industries and analyze them with more technical knowledge. From a technological perspective, you can utilize filters, alliances, and other tools. Hui is one of the Chinese companies I mentioned earlier. Let me explain it this way. Noba Oracle Nise.
From ARM World.
TTD is coming out again. TTD was there too, but next is Punstora and also Punstora. Recently, if you look, there are stocks that go straight up like this. But if you look at it this way, if they are still undervalued, these kinds of strong companies can go up like this in one shot.
It went up.
It's falling. In this way, you can see various companies classified by industry, and then you can look at them by sector, or you can look at them by the value chain, or you can look at them by software. If you select like this, you can see them sorted accordingly. Jumi Gyeongjang-si, you've been working in the office for several years, but this is your first time coming to this office, right, Jumi-si?
In the United States stock market.
With stocks that have received a lot of attention. During the coronavirus disease 2019 pandemic, stock prices surged dramatically, but as interest waned, prices plummeted. Initially, the price to earnings ratio was very high, but now it appears to have reached a more reasonable level. Shinho came in at around $77. If you look at the score, the growth sectors haven't dropped, but the value sectors have gone up. Compared to that, the price of Amara is very low, so it's coming in as a value stock. When you do things like this, the change in the stock price is immediate. So when the growth stocks change, you can adjust your portfolio safely. I think this is the kind of supplementary role it can play. The order book currently shows an option held by Hui that's just starting to appear at the top. While not recommended solely for its position, it could be used as a portfolio stabilizer or hedge if it gains attention from many people.
Yes, you can see the content by going to the investment recipe menu in the sales section right now. Yes, that's right. Yes, that's good. So for investors who want to find stocks that are currently on sale by sector, this feature has been newly set up. So I think it will be good to use it every week. This is how things progress. I'm telling you the truth. Then I think we should have a fundamental discussion about the topics we prepared today. American public elementary schools are currently in session. What grade are we in now?
I'm also coming in. Who made a promise? Elementary school is clearly right, but sometimes it feels like we're moving on to middle school or even high school. There are times when it seems like we've learned a lot, and other times when it feels like we're still just getting started. In my opinion, even though we say our curriculum lasts for 6 years, if we look at it from the Korean perspective, it's 6 years. But in reality, I don't think we've even fully covered 3 or 4 years worth.
That's what I think. But the reality is a bit different. Up until last week, we studied various financial statements and risk lists, but this week I think we'll be introduced to a new topic. Do you remember what we learned last time? Yes?
If we go back to the very beginning, financial statements are the results that come out of a company's business activities. So what's important is not just looking at the financial statements themselves, but understanding what kind of management this company is running and how the business is doing through the numbers in the financial statements. That's even more important. So starting from the balance sheet, we explain one by one the items of assets, the items of liabilities, and the items of equity. And in the end, we explain the entire financial statement in that way. So you might be able to skip over some parts, but if you go through the last part about liabilities, you'll be able to see how to analyze the risks of a business in this way. So financial risk, the risk that can be avoided through cash flow. Next, there are risks called survival risks for very risky companies, then portfolio risks, and then market timing risks. These are the kinds of risks you need to consider and manage. Financial statements categorize risks as internal and external. The discussion was about portfolio allocation, not only those factors. Let's revisit the basics and conclude with the financial statements. We'll examine the statement of retained earnings, one of our key financial statements, for the second time. So today we're going to focus on the most important parts of the income statement, especially the sections related to sales revenue. We'll organize these sections first, and then later we'll look at sales revenue by category and by industry growth stage to see how investors can use this information effectively. We'll go through this step by step together.
From today, you can look forward to the income statement section that you've been preparing for. Now, let's get started with the main part of the lecture.
Can you see it well? Today, I will explain the method of revenue recognition, focusing on the structure of the income statement and how changes in sales by stage are generally reflected. I will also briefly introduce the concept of patterns and the core idea of PSL, and then proceed with today's class. Next time, I will try to explain this part in more detail and in a way that is more practical and applicable to real life. You may not remember this screen, but if you are seeing this screen for the first time, you should review it again from the first lesson, and then watch this part again from the first chapter. When I first started, I showed you this screen and told you that you need to understand this screen in order to understand the financial statements, and that only then can you move on to the next level. So if you keep the screen in mind later on when you look at various companies and analyze them or look at investment indicators, you will be able to understand them more easily. In this part, if I explain it simply, you earn your own money, save it, and then separate it to manage your total assets. Based on this, you invest in advance, so it's called current assets and non-current assets. Assets are divided and used to create products and services, which are sold to generate revenue. After deducting expenses, the operating profit is distributed as dividends or retained as retained earnings, which is added back to the capital. And mainly, the company either pays dividends or reinvests the profits through capital increase, so the money keeps circulating. That's how I explained it. So until recently, the main shareholder has been directly allocating the financial statements on the left side, which is the asset side. Starting today, we will go through the income statement one by one So today I will try to explain the most important and representative parts of the income statement. The structure of this income statement is simple. Profit indicates that a company with high sales and margins is considered successful. If you maintain this perspective, that's acceptable. The income statement has fewer items to review compared to the balance sheet. So if you just know a few key points that you can invest in or things like this, you can look at it much more easily than the balance sheet. First of all, I think it's important to experience the structure itself at least once with your own eyes. If you look outside more, it would be better, but initially, the full amount from a sold item is considered as our sales revenue. The necessary English words are all listed on the board, so you can see them while you study. We call it sales revenue here. So if you subtract the original cost, which is the expense incurred to make and sell the product, from the sales revenue, the remaining amount is called gross profit. That's why we refer to it as total profit from sales. After making the product, there are additional costs that come in later, such as expenses incurred when selling the product and general administrative expenses. When we subtract the selling expenses and general administrative expenses from the gross profit, we call this operating profit. Among these, operating profit is the most important. Operating profit is the most important indicator that shows the company's ability to generate profit from its core products and core services. And this part ultimately refers to the parts that are not included in the company's main operations. So there is something called non-operating profit, and next is financial profit. Financial profit is sometimes included in non-operating profit. So to sum up, if you look at it in terms of accounting, there is a term called non-operating profit. But the reason why financial profit is separated from that is to distinguish companies that receive interest income and pay interest expenses as their main business. So in order to see whether the interest was generated from interest income or from other business activities, we separate them like this and divide operating profit and financial profit. If you subtract expenses before you pay corporate tax, the amount before paying corporate tax is called pre-tax income. And in English, we call it earnings before tax. Here, if you pay only the corporate tax rate, the net income comes out. That's how the structure is organized.
So from here,
So the parts that many people need to pay close attention to are the actual costs above this line. This is how the structure is set up, and the expenses are shown in gray. So you can see how these expenses are controlled and reduced, which ultimately determines the company's profit or loss. So depending on how you handle the cost of goods sold, how you manage sales expenses, and how you control these external business costs, your profit can increase or decrease accordingly. So what you need to remember here is that just understanding the difference between sales revenue and sales management expenses should be enough for now. They're both expenses. For example, the cost of making a product is the cost of goods sold, and the expenses involved in selling it are selling expenses. So if you wonder why we separate the cost of making the product from the selling expenses, just think of cost of goods sold as the expenses that go into making the product. And selling and administrative expenses are the costs that come after the product has been made. Typical examples include marketing expenses, advertising expenses, and transportation costs. Most of these fall under selling and administrative expenses. The largest expense within the cost of goods sold is the raw material cost, which encompasses all costs associated with manufacturing the product itself. Next, labor costs are also included. Labor costs are included both in the cost of goods sold and in selling and administrative expenses. So when it comes to labor costs, if you are working in the factory making the product, or if you are directly involved in the production process, then your wages are included in the cost of goods sold. I'm an administrative staff member, but I'm in the marketing department. So if you're selling or handling products, then the labor costs for these people are included in selling expenses and administrative expenses. The total labor cost should consist of both the labor costs included in the cost of goods sold and the selling and administrative labor costs. So you have to separate the two. And if you look at it this way, for example, service companies may or may not have raw materials because service businesses don't make products, so they may not have raw materials. So sales revenue becomes the total sales amount, and sometimes it's also referred to as operating revenue, but that's not always the case for financial businesses. Cost of goods sold mainly occurs in companies that manufacture products. Understanding this concept in this way makes sense. If you understand it to this extent, you shouldn't have much difficulty understanding the structure of financial statements and the income statement. Next, there's another part you need to pay a little more attention to. This is where operating profit and non-operating profit appear, but sometimes it's different. In the case of most general American companies, they often own 100% of their subsidiaries, so there's usually no difference between net income and controlling interest net income. However, there are some companies where this is not the case. In that case, the difference between net income and controlling interest net income starts to appear. For those examining the original financial statements, note the slight difference between net income and net income attributable to controlling interests. This is where you should focus your attention. You might wonder why there's a difference, but once you understand and move on, it won't be too hard to grasp the flow of the consolidated financial statements. This is the part where we look at the consolidated and non-consolidated sections. And when I was explaining this in class, I used a slide to show it. On that slide, I gave an example. There's a company called A, a company called B, and a company called C. Let's take a look at this example together. And then some people own shares of company B, and there are people who currently hold shares of company B. That's the structure. Let's say you're not a shareholder of company B, but rather a shareholder of company A. Company A owns 90% of company B, and company C owns 10% of company B. So imagine that company B is structured like this. If company B made a $100 million profit, company A would receive $90 million, 90% ownership, and company C would get $10 million, 10% ownership, totaling $100 million. Company A owns $90 million, while company C owns $10 million.
The $10 million belongs to company C.
So what I'm saying is I'm actually paying for this, I'm actually investing, and I'm just asking you to consider the part of this amount that I've invested as my share. I'm just asking you to recognize the portion of the funds I've invested as my share, just like the percentage that others have contributed here. And the remaining 10% is not under control, so it's called a non-controlling interest. So in English, if you look at the table, it's written as controlling interest or minority interest, and that's how non-controlling interest is expressed in English. The terms controlling interest and non-controlling interest are found in the total equity or equity section of financial statements. In the consolidated statement of changes in equity, some companies show controlling and non-controlling interests separately in the short-term changes section. So, in reality, the controlling interest is the core of the profit that investors in company A are looking at. When conducting a valuation, we calculate the PDR and compare it to the market capitalization. Only around 90% of the earnings are attributable to shareholders, so using 100% of the earnings in the comparison is incorrect. Since the remaining 10% is not ours, it's the value held by company C, which is a minority interest. So when you do the valuation, you should base it on the controlling interest. That's how you should understand it. For Korean companies, the rankings based on controlling interest often differ from those based on total net income. When valuing a company, the numbers can differ significantly depending on whether you base it on controlling interest or total net income. Controlling interest rankings are crucial, but for United States companies, there's often little difference between the controlling interest and total net income rankings. The discrepancies in the numbers are due to the distinction between controlling and non-controlling interests. Understanding this will help you grasp the overall framework, even though it doesn't require close attention. Next, for the second part, I'll explain the indicators. When we look at investment indicators, there are various investment indicators that appear in the income statement, and these investment indicators are often disclosed officially. The export sales ratio is export sales divided by total sales, and the operating profit from exports is the operating profit from export sales. But as you keep looking at it, you start to understand which numbers go into the numerator and which go into the denominator. Many people misinterpret the official formula and miscalculate investment indicators. Today, I'll help you understand investment indicators without memorizing formulas. I'll show you myself. The main investment indicators are gross profit margin, sales profit margin, total sales, operating profit margin, operating income, and net income. Take a close look at these terms. Sales cost, gross profit, selling and administrative expenses, operating profit, and net profit. So all the items you see here are actually listed in the income statement. Which item appears first in the income statement? The start here begins with sales in the income statement. The idea is that you start with sales as 100 and then subtract from there. That's the concept of the income statement. So the denominator is just the sales amount. When the formula ends with divided by sales amount, that's why the denominator is sales amount. in the income statement. You start from sales amount and subtract as you go. So that's why. So we calculate everything based on sales amount as 100. That's why we talk about sales margin ratio. If you set sales amount as 100, how much is the original cost? If you set total sales profit as 100, how much is the total sales profit? When you set sales amount as 100, the operating profit ratio is calculated. And when the formula for operating profit ratio ends, that's it. Operating profit margin is calculated from the income statement by determining the percentage of operating profit earned from total sales. This ratio is sufficient, and the overall investment return ratio is not necessary in the income statement. Next, for the second one, think about whether it's better for this number to be high or low. Try to think about it once. Original rate profit margin, if you look at the profit margin, there are three types here. Higher total sales profit, operating profit, and net profit are better. So yes, it's best when total sales profit and operating profit are higher. The end. To increase profits is essential to reduce expenses, also known as the original cost or selling expense. A lower original cost or selling expense ratio is more favorable for leaving behind a significant profit margin. So if the sales cost ratio goes down, the company's margins will get better, right? Then if you want to lower the sales cost ratio, how can you do that? So in manufacturing industries, the price of raw materials has a big impact. If the price of the raw materials you buy goes down, the cost ratio goes down, so the margin gets better. So basically, things like crude oil, petrochemicals, steel, and energy, these are all raw materials. So the prices of crude oil or energy, or even shipping costs, have a big impact on the price of raw materials and their margins. Service industries aren't affected by raw material costs. In the United States, service and biotech companies' profit margins are more influenced by research and development or distribution costs rather than raw materials. If R&D costs increase, profit margins may decrease, but they are generally more stable overall. Because if you don't invest in research and development, you won't be able to achieve growth next time. So it's not necessary to view companies that are increasing their R&D expenses too negatively. During judging, they first tried to minimize direct personnel costs, but material costs rose significantly. These issues require a different perspective. So the most important parts of the income statement are first understanding the structure and then moving on to the next sections. If you understand these parts first, it won't be too difficult to grasp the overall income statement. Now let's open up a real income statement and take a look. Among the investors here, are there any of you who have never actually opened a financial statement or an income statement before? The numbers and terms like final settlement or summary in legal documents can be intimidating and overwhelming, making the process seem daunting. I'll try to explain it simply. We're currently reviewing NVIDIA's income statement. If you look at the top, can you see the sales amount? Below the revenue, you see the cost of goods sold, which is the cost of making the products. Next is the gross profit, followed by the deduction of selling and administrative expenses. The result up to this point is called operating profit. Here, R&D expenses are sometimes included with selling, administrative, or general expenses, but are often separated out as shown. For information technology and similar industries, R&D expenses can be a significant percentage of sales. Investors consider the amount of sales invested back into R&D, as it's crucial for determining the company's future competitiveness. Therefore, R&D expenses are often separated and shown independently.
Divided by sales.
Next, earnings before interest, taxes, depreciation, and amortization. Originally, it's not an item in the income statement, but since investors often look at it as an investment indicator, it's just included there. Earnings before interest, taxes, depreciation, and amortization is not originally in the income statement. Also, today, I didn't go into detail about earnings before interest, taxes, depreciation, and amortization, but I'll mention it briefly next time when we talk about investment indicators. The earnings before interest, taxes, depreciation, and amortization indicator can sometimes show different values, even for the same company, depending on which service is used. Even when using the standard earnings before interest, taxes, depreciation, and amortization definition, official numbers can vary slightly between companies in the same industry, rarely matching exactly to the decimal point. Depending on the platform and data source, the numbers you see might look similar but can be quite different. The financial data from FactSet, Refinitiv, or Bloomberg can vary depending on the source you consult. Even the finance numbers might not match exactly. Earnings before interest, taxes, depreciation, and amortization figures can vary slightly by source, causing confusion about the discrepancies for the same company. When asked, there's no clear explanation. Is there an official method to calculate earnings before interest, taxes, depreciation, and amortization? When examining differences, view discrepancies with this perspective. However, keep the gap relatively small. So from here, let's talk about the flow of business from now on. After discussing operating profit in more detail, next we'll move on to financial expenses and interest expenses. If you skip this and look at corporate tax, originally there should be a corporate tax adjustment line here, but since it's not necessary, it's just omitted. So after deducting corporate tax, the resulting net income is the basic structure of the income statement. This is the same format we've seen before, and you can see that this is how it's currently structured. To calculate the original cost ratio, take the cost of sales, 148,515, and divide 44,393 by it, then multiply by 100. That's how you determine the percentage of the original cost compared to total cost of sales. That's how the ratio is calculated. Looking at it this way, you'll see how it works. If you look here at the top, you can see the financial statements are divided into 3 categories. There's something called annual and something called period, and there's also a division. When I check here on the right side, the one labeled annual is trailing 12 months. So the most recent 12 months, the sum of the data from the last 4 quarters is called trailing 12 months data. Annual refers to the data released each year as it is, and quarterly is the data for each quarter. When you look at it this way, you might wonder why we use trailing 12 months data. The reason is that annual data only comes out once a year, so there can be a time gap, and the data may be a bit outdated. The problem with quarterly data is that there are industries where the results fluctuate a lot depending on the season. Yeah, for some specific seasons, sales can spike, while for other industries, sales can slow down. That's how it works. In the banking industry, terms like net interest margin and non-interest margin are commonly used. So if you analyze by quarter, it can be quite misleading.
That's why, in the case of the travel industry,
The trailing 12 months method allows you to analyze annual data without significant distortion by examining the total figures for the past 12 months. I'm providing these 3 values together for your reference. I think it will be helpful. Right now, After Hours Finance is one of the sites that a lot of people in Korea as well as overseas check. Since you can view financial statements for free, those who are comfortable with English will find it easy to use, but for those who aren't, it might be a bit difficult. So yeah, when you switch everything to Korean like this, those who are more comfortable with Korean can easily understand the financial statements and see what's going on. Let me show you a comparison. If you look here, you can see the period ending January 31st, 2025. This is shown as an annual period here.
here it says trailing 12 months.
It's the same here. The annual sales here are based on the same concept as the company's annual sales over there. Here, it's trailing 12 months. Looking at the annual data, it's the same.
130,497 and
Next, the original value.
32,639, 97,858.
This is how you put it in. So the business comes out like this at 81,453, and then these numbers also come out differently in different cases. But now, in cases like this business finance, if you make the adjustment and detailed items minor, the total amount doesn't come out as a sum, but rather as a weighted average. So when you check those parts, it's better to be a little careful. Today, what I really wanted to emphasize and talk about is, hasn't NVIDIA actually made an announcement after the earnings call? So they announced their earnings, and from that you can see that we already have the breakdown data available. But later on in the finance section, I'll go over whether I personally think it's good or bad, so please stay tuned until then. To explain why, it's because the updates can be different since it's the United States, and the timing can vary, but even right before I started filming, the data hadn't been updated yet. So what I'm saying is, even now, the data hasn't been updated on Yahoo Finance. The data from Korea gets reflected in the United States market the day after the announcement on the 28th, when the United States market closes and a new day begins due to the time difference. So for us, when we check in the morning in Korea, even if we check early, like around 9 or 10 anti-meridium, this part might not be updated yet.
So probably
You'll be able to see it within a fairly short time. In the United States, public releases are actually done in 2 ways. Sometimes they release it as a so-called actual 8K, and then later, after it's fully reviewed, they release it in a 10K or 10Q format. Q refers to the period and K refers to the year, but in cases like that, usually the official confirmation comes out first as a 10, and then the period or annual report is updated the next day or so.
that's right. But
Actual results may be announced a few months later, so updates might not be done Immediately, members sometimes ask why updates haven't been made after the announcement. In those cases, we don't update the financial statements yet because sometimes not all the detailed items and accounts have been announced. So when you look at it that way, the updates for financial statements are done for the 10th period quarterly reports, semi-annual reports, and business reports. Once those are announced, we update everything the next day, so you can think of it that way. Since we update the financial statements on our side quickly, you can use this actively when investing, and I think it will be helpful for you. Lee.
Before moving on to the next screen, I wanted to briefly talk about some content related to today's broadcast, so I brought it up. Today, while analyzing NVIDIA's earnings, I mentioned that one of the key points is that in the past, about 70% of NVIDIA's total sales came from the data center business, but this time it didn't even reach 60%. That's why some people are worried. If you look here now, when you look at it on a trailing 12 months basis or on a year-over-year basis, the total sales profit margin is 104 and 121. Sales amount of 148 and 515 is around a 70% difference. So if you look at the past year, 70% is correct, but in this period, 60%, but it's not just that 10%, so you shouldn't look at it that simply. That's the reason. There's a bomber called the H-20 that China is developing, and it was rumored to have a range of 4,500 miles. But now there's no more talk about its range, so they're probably just handling the costs and moving on. If the original sales were around $4.5 billion and sales dropped further, the total sales volume dropped by about 10%. When you understand this part later, if you look at these numbers, it will be easy to understand. That's how it is. To see the breakdown, you need to click on the annual report. That's how it works.
In the meantime, I went directly to the site to see how the breakdown is shown, and I checked it out. The representative just explained it, and if you want to see it in that way, you can also bring it up as a pop-up window. There are cases like that as well. I don't understand why the sales margin is coming out like this, especially for this company. Like, it seems like there shouldn't be a reason for the sales margin to drop. At that time, I opened the original electronic disclosure on the DART website and checked the finance statement directly. There is a section for cost of sales over there. It was written in English and it was labeled as cost of goods sold. Then in that text, if you look at our notebook or computer and press Ctrl+F, you can easily find the text like this.
After that,
If you just type host of there, only the relevant parts will be highlighted and shown on the right side with a colored box. If you go into that area, Mr. Ama will explain why these properties are being reappraised, how the appraisals were handled, how much the prices have changed, and so on. He'll explain all of these things.
that's the example. Then,
When you explain that, you can say things like, when there was no relationship with China, the margin was still solid, and so on. These are actually parts that correspond to a realistic analysis, and you can go even further with that. So could you please explain that part on the broadcast, Mr. Depio?
because you're doing it.
If you look for it like that, those of you who are curious can find it and watch it. I think it will work if you do it this way.
Yes, that's right.
Next, it's not a fundamental issue anymore, but it continues to be a fundamental issue. I'll bring up one example and explain it now. We need to check the increase in sales according to the stage of our industry's growth, and it's important to identify the characteristics that we should focus on at each growth stage. Then, we need to look at the indicators we should pay attention to next, and after that, we should see which indicators are shown by each stage. This is good to know, but we'll talk about how these will change over time later. For now, let's look at how things are going today. And in actual financial statements, if you look at it like this, you can see whether this company is in the growth stage or if the growth stage is over and it's moving into the maturity stage. So when you evaluate this industry, it's good to judge what you should focus on and how you should approach it by looking at these things, checking the changes in sales and seeing where you are positioned.
First time.
In the case of the introduction stage, there are either no sales or only small sales. These industries usually have high prices or are expensive due to low demand. For example, if a company has developed a new technology, or has made a breakthrough, or has become a new partner, or if NVIDIA is mentioned as being interested, these kinds of news can cause the stock price to fluctuate sharply right in the introduction stage. Sales are either non-existent or minimal. So to put it simply, these are stocks with low liquidity, and that's why they're called penny stocks in the United States. For those watching elementary school videos, it's not recommended to invest. This is because elementary students are not the intended audience. This is because I know the story and management of this company, and I've also looked into how this company became a mega trend and how it grew. Since there's no clear sales volume, you have to invest only if you understand the story from the beginning to the end. Just because it's simple doesn't mean you should buy it, and it's difficult to get into the comments right away. Here, if things go well, the stock price can go up 10 times, 20 times, even 100 times. But on the other hand, 98% of the time it drops and disappears. That's why for beginners, these are industries with a very high level of difficulty, and you need to keep that in mind. The industries we should mainly focus on are likely to be these two, those in the growth phase or those in the maturity phase. Industries in the growth phase show rapid growth like this, and then as they move into the next stage of the industry life cycle, their growth rate slows down. At this point, the change in sales growth starts to decrease. If it doesn't decrease, it's still in the growth phase. For example, if a company has been around for 5 or 10 years and continues to grow steadily without any slowdown, it's still considered to be in the growth phase. But when the sales growth rate starts to drop in this kind of situation, that's when the change begins. The periods of that growth rate curve
for a long time, for several years.
These types of patterns that emerge during the initial phase go straight into the growth phase, and this is when the most stocks come in, the most money comes in, and you have to invest. I'll explain these points in more detail in the next video. So after the growth phase, when you move on to the next stage, which is the maturity phase, the growth rate starts to slow down a bit.
So the growth rate,
industries with relatively low growth, around 8%, but generally the growth rate starts to drop to about 10 to 12%, or even as low as 8% for some industries. During the growth period, sales growth rates can range from 30% to 100%. As time goes by and the growth period ends, the growth rate gradually slows down and the company enters the maturity stage. Investors who invest during the growth period are usually called growth investors, while those who invest during the maturity stage are often referred to as value investors. There are many people who prefer value investing, but generally investing during the growth period is considered growth investing. Here, value investors or even angel investors like Cheon Sa can invest, but in reality, only a small number of people actually do so. Most people who invest at this stage are the so-called professional investors or angels. So, since the sales growth rate slows down here, you need to be especially careful. In particular, you should be most cautious with companies that are transitioning from the growth stage to the maturity stage. When a company's rapid growth slows, its stock price may stagnate or decline, even with a fair valuation, due to the loss of high growth. But in the past, even during the growth period, the price-sales ratio was valued at 10 times, so as long as sales kept increasing, it was considered reasonable to get a 10 times price-sales ratio. However, when the company transitions directly into the maturity stage, that part can change drastically. If growth slows, the valuation should decrease accordingly. This applies to any valuation model. When forecasting valuations or discussing the future, you can mention certain points, but exercise caution when going further.
so during the growth period,
The maturity stage doesn't mean growth has stopped. Even in the maturity stage, earnings per share can still grow by about 20% to 25% per year, just like it did in the growth stage. So, since earnings per share continues to rise, the risk of missing out compared to what you expected becomes higher. So, for industries where growth is slowing down, especially those that are about to enter this kind of phase, it's best to either organize your portfolio in advance or gradually shift your investments to ones that fit the maturity stage. Next, to wrap up, these two categories are what I just mentioned. The industries that have entered the maturity stage fall into these two categories. Some industries can easily maintain sales and profits over time due to their unique characteristics, while others cannot. These industries persist in this manner. I just mentioned some specific industries as examples, but even within the same industry, there were companies that used to be number one, but now, no matter what they do, it doesn't work and they keep trying to survive, but their sales just don't increase. There are companies like that. During their growth and maturity stages, those companies attracted investments for technology and R&D benefiting from them. But now, companies that have prepared well for the next stage are entering a phase where they can grow again, or even become the main players in growth after entering a new growth period. So companies with strong fundamentals go through cycles of growth and value, then growth again, then value again, and so on. The companies that continue this kind of cycle are the ones that show the best pattern of growth. Now, I think there are a lot of American companies that fall into this category, much more than in Korea. That's why investors are focusing on such companies. Last time I talked with Mr. Dapio and mentioned Google as an example, but actually Google is not a growth company anymore. Its growth rate was over 10% before, but now its sales growth has slowed to 12%, 11%, and it's becoming more mature. In this situation, it needs to find a new direction. But if the company's main businesses like search and advertising stop growing and there's no new investment, Google could also face difficulties. If they make investments that fit the artificial intelligence era, they can grow again. And by making those investments, their growth period could be extended or even accelerate. Personally, I think Google has the capabilities to prepare for another leap forward, so I have a positive outlook. I also shared this opinion with the representative that day. Google is a mature company that still has the potential for midterm growth, a rare capability among large companies in their maturity stage. This is how I can give you a rough example.
Major tech companies like Meta, formerly Facebook, Google, and Amazon, are currently in a similar stage of their cycle, focusing on artificial intelligence.
Finally, I'll cover price-sales ratio valuation metrics. The link between market cap and valuation indicators show real examples from financial statements and then conclude the class. Price-sales ratio is a valuation metric based on sales. Here, price to sales means price, and you just put the price in front of sales. So it becomes price divided by sales, which is how you get the price to sales ratio. So when we say price sales ratio, it means the ratio of P divided by S, with R standing for ratio. That's how you can understand it. So you don't really need to memorize the official term. When you hear price sales ratio, just think of it as P, S, and R as they are. PSR, that's how it goes. So P is on top, S is on the bottom, and then you just look at the ratio. If you remember it this way, it's not that hard. So when we say price sales ratio, the price goes on top here, and now this becomes P. The market capitalization is P, and the sales amount is S. This is the ratio that compares these two. So the lower the price or the lower the P, the lower the price sales ratio becomes. The lower it is, the more undervalued it is. That's how we evaluate it. So I'll talk about the price sales ratio chart next, but rather than just looking at the current level, you should also check how the price sales ratio band has been over the past 10 years or more, and how the company's growth was during that time. So I'll talk about that indicator together with the next topic. So price sales ratio is simply the market capitalization compared to sales, and that's how you look at it. But why do we look at price sales ratio? There are PER, polymerase chain reaction, PDR, PEG, and many other indicators. But the reason is that price sales ratio is mainly used for industries where it's difficult to calculate net profit. So people look at this indicator a lot. The reason for that is because there are early stage companies where earnings haven't occurred yet and only sales are being generated. In simple terms, these are companies with no or minimal sales. Industries such as biotech, startups, or companies in their growth or early stages often have low earnings visibility. When valuing such companies, you often have to use the price to sales ratio instead of the price to earnings ratio. Before you use the PER, or sometimes before you use something called EBR, you can compare the parts that are directly related to sales. This is a type of valuation method that compares sales figures directly. So if you look at the parts related to sales like this, I think it will be helpful. So now I move to the Jihu site and brought up the actual financial statements, and I will only look at two companies as examples. Yes. First, NVIDIA. NVIDIA is up about 5.5% in the pre-market today. If you look here, there's a section called Financials. If you click here, you can see the financial statements like this. My account balance looks high today. Are you seeing the same thing? Yes, I see it. Enlarging it is good. It's at max size. You can see Jon Hansen's record here now. I'll zoom in on this part. If you zoom in, you can see that the Demujafjorga of the record was announced like this on April 27th. As you said earlier, if you look at the original price in the sales statement, you can see the original price rate. If you look at these two, you can see that the response rate here was about 25%, but right now it's even lower than that, and it's much lower than before. So we need to find out why the company's export margin has dropped so much. So where did it drop? There's nothing special here. Here, the adjustment items are not shown in the financial statements or the income statement, so there are no adjustment items here. It's not that you can't see it here, but rather these are industries that are not disclosed in the income statement. Instead, they are included in the financial statements, such as the notes to the financial statements, the footnotes, or the business report, where companies provide explanations or additional information. You can check them there. You just need to find it there. I don't think I can show you everything today, but I'll tell you how far you can look and what you can find. If you look here, you can see what's being provided.
I don't know.
It's supposed to be a powerful feature, but you can't see it unless you open it. If you check the track settings over there, you can see it. You don't just look at the main topic every time. You have to look at this to really understand so that you can analyze it in detail, like Mr. Diapio does. Here, it's called SE Electronic Disclosure, so you can go directly to the disclosure of NVIDIA and all the links are connected. You don't need to go to Edgar and search for NVIDIA, then look for 8K or 10K like this. If you press it, everything comes up here. You can view only 8K, you can view only 10K, and recently, files have been coming out like this. If you look here on May 28th, you see the 10Q comes out, the 8K comes out, and the 8K is an actual report. And this is listed as an article type release. The 8K is announced, but the material disclosure update hasn't been updated over there yet.
That's how it is. But
on the same day, May 28th, the official 10Q report was released. So if you open the official report, you'll see a lot more detailed information.
that's right. But
But
at this time, I was confused.
still, I had to look for those things. If you look here, in item 1 of the balance sheet, there's something called cash flow, and here is the current cash balance. Then next, here is the owner's equity and the balance sheet status, and here is the income. And like this, here is the income statement. Then from here, you press Ctrl plus F, and from here, you can search for those kinds of costs, and then you can check them like this. If you type enter like this to find out where the error originally occurred, oh, here it comes out and it shows you exactly and clearly like this. About the theory of variance, the things about variance, we will go over them briefly and simply just like we did before. You can find it like this. Yeah, I looked it up, but I couldn't find the English, so I just copied it. And I asked Generative Pre-Training Transformer to translate it, but I don't know what this means. Please explain it to me, and if you can, please explain it. When you use it in this context, you lower the tone, and if you do it like this, it works. So if you look it up this way, you can easily find the parts that you need to look for in the original, just like many others do. If used properly, this will be beneficial. There's nothing special about this company in the financial statements. In business transfers, there are advantages. Financial expenses are included as a negative. In 21,638, the business transfer is positive, but financial expenses are higher. Since financial expenses are originally negative, they are calculated as a minus here. And next, I'll show you another case. Here, financial expenses come out as a minus for the industry, so I'll explain how to interpret that industry. I showed you meldate.com once, but if you look at this financial statement, it's not something I would recommend. It's a bit sensitive, but I'm just showing it as one of the good examples. If you look here, can you see it just as a connected line? If you look, this company's sales have been slightly declining, and in terms of operating profit, it's still in the minus, but it keeps staying in the minus. But if you look below, the net profit is still in the red, so you need to analyze these cases carefully. The difference between operating profit and net profit and why that gap occurs and how to find it. I'll explain that separately at another time. It appears the income statement ends at this point. In short, operating profit belongs to the company, while net profit is for shareholders. This is why net profit is considered the profit that can be consistently distributed. It can temporarily turn into a profit, but then become a minus again. To judge this, you have to look at it carefully. So that's why I made this 53, and this was the most important thing. Financial expenses, in the case of financial expenses like NVIDIA, there was no minus in front, it was a plus. But now financial expenses are well attached to the minus in front. If you look at it like this, minus 60, minus 56, minus 55, since this is only about 100, it means there was a transfer of about 60 million. For that minus, it's not a financial expense, but rather this interest income occurred. This interest income over 1 year generated about $60 million. So the net profit was about $53 million. Most of it was simply covered by this interest income. The company generates more net profit from interest income than its core business. Given the current numbers, the logical conclusion is that as long as the company retains its cash, the interest income will likely persist. So, if you want to make sure this interest income keeps coming in, you have to check whether this company actually has cash. You need to check where the cash is. And to do that, here,
It's Q Jin. Where should I
look? If this company wants to receive this share, it needs to have the funds right now, or the investor who put in the funds must still have the funds so that the transfer can take place. They say it's an asset because it's money that's been put somewhere, and they include it in the financial statements as an asset. So if you look right below, you'll see that this company's total assets are $18 billion. Out of the total assets of $18 billion, $15 billion are
just cash? That's it, simply.
investment. If you combine those two, it's about $16 billion in total. Of the dollar, 1.8 billion in assets, approximately dollar 1.6 billion are in cash, investments convertible to cash within a year or held as collateral. This is the structure we're considering. So from there, this money is being moved up to the holding company, and that's how this flow is being created. That's why, as long as they don't spend this money elsewhere, the interest income can keep coming in, and if interest rates go up, these companies will benefit even more. Rather than decreasing, the interest income will actually increase. Because there are structures in place.
그런데 이
But the company called Molde.com basically has no major investors. If you look here, you can see that we are spending money to help our company grow. But if you look here, Yu Hyung-ja and Lee Gyeon, tangible assets are basically assets you can see with your eyes, and they are related to facilities and equipment. As you can see, there aren't many of those since it's a software company, so there isn't much need for special facility investment. Next, but the fact that intangible assets are zero means that they haven't done any M&A. Usually when a company does M&A, things like business rights and intangible assets increase. But since this company doesn't have those, it means they haven't done any M&A so far. Cash is abundant, so no additional investment is needed.
from that perspective,
You could say it's a company in that position. So this company can continue to generate interest income, and those things are recorded as financial expenses. And now there are more and more structures where this becomes net income. So if you look at this company's sales volume right now, it's about 1 trillion won, but next year the expected sales volume will increase even more. If you look here, this year it's $12.2 billion, and last year it was $10 billion, so $12.2 billion.
and next,
$1.5 billion.
about this much?
If we move into this year, the possibility of a full recovery in the semiconductor industry is still very low. And even if the industry recovers, it will take some time for the benefits to reach the component makers. Net profit was originally positive, and even last year, it was only the interest that turned it negative. Currently, a significant portion is likely to become positive just by the interest. But when operating profit also turns positive, you can see that this growth potential is actually quite high and the momentum is quite strong. In other industries, if not, then sales size is not a big company because they have a lot of cash flow when acquiring this company through M&A. They have the ability to buy it, and since they are growing, they can also invest more money. I got the impression that they are operating with a very stable cash flow. So Bonsaga is a company in Israel, and that's why it's that kind of company. So even if you only look at the balance sheet, you can interpret the numbers in various ways depending on the accounting standards. So don't just look at the simple numbers. So if you just look at the original cost as the acquisition cost, you might think it's a temporary asset. But in the case of something like inventory, it's not always temporary. If raw material costs keep rising, it could recur, but this time it's over with nothing left. Another cost ratio increase next period could make this a recurring problem. When making such judgments, financial analysis is crucial. We must be capable of reading the financial statements ourselves. But in reality, do you think just looking at the model or the momentum is enough? Sure, you can do it that way and make profits, but if you make investment decisions based on more data, your chances of success will increase. Now, since you have your own standards, you don't just invest blindly. I think that's why you're able to make profits. Today, that's all for the income statement lesson.
It was a very helpful lecture that didn't just stick to theory. Today was another satisfying NVIDIA earnings announcement, and the balance sheet was even more interesting. When the H20 is released at the end of this year, the stock price could rise by 4.5 trillion won, and seeing the numbers react to that makes it even more interesting. Seeing the financial statements like this, it was very clear that you can invest rationally. Next time, we will look for new parts in our income statement, so please look forward to it. I will prepare well. Thank you for watching today as well. And today, I was told to say goodbye on behalf of Kim Min-ju, the host of our show, but I have to do it, so I said these words. Today, we also worked hard for 50 minutes late into the night. Next week, I will try to finish the broadcast a little faster on Thursday so that I can greet you within my time. Please take care of your precious weekend. I will greet you again next week at the usual time for the United States stock market opening broadcast.
Thank you. Yes, thank you.